talk to me about I think is it the really nice Airbnb that you have is it Arizona maybe?
Yeah, I've got a few is the one in Scottsdale?
Yeah, I think it was the one in Scottsdale. And that was a little complicated. You had to use, I think you did a policy portion, you did a hard money, then you did the Burr method, but can you talk through that process?
Yeah.
Because a lot of people think that they can't do real estate. Like they can't invest in real estate, or they need to make $1 million or have a stack a bunch of cash to be able to do that. And that's not really true. If you have the mindset for it, you educate yourself. There's a lot of opportunities out there to start, getting one, then you leverage that to get another one. But anyways, can you walk through that process that you did?
Yeah. So you kind of touched on it earlier that infinite banking takes a while to kind of get some steam, because that's compound interest. It doesn't do much at first, but over time, compound interest just exponentially grows.
Right.
What I've done though with policies, like even Chris, I've taught him some things. He's like, dude, your mind, the way it works, like it's crazy. So what I did on this is I generally borrow hard money to buy properties.
What is that?
Right? So
for the
I'm sure everyone knows what hard money is.
No, I doubt it.
Okay. So hard money is just, it's an institution that lends on properties, and that's all they lend on. They look at the deal. They don't look at you. They don't look at your credit. They don't look at you as the borrower. They look at the asset. Is the asset a good deal?
Yeah.
And 9 times out of 10, if it is, they'll lend on it. They'll give you the money. So that's how I usually buy properties. Hard money loans, usually at like 15% interest.
Yeah.
12 to 15. And then what I do generally is I borrow private money. So private money is just anyone that has money. Like I could borrow from you. I could borrow from my mom, my dad, brothers and sisters, Joe Schmo off the street. That's private money. So that's how I generally would do deals. That's how most people in real estate think. Buy on hard money, renovate on private money, and pay them interest.
Yeah.
And that basically gets their cash in the deal down, because they don't have to buy the whole thing with their cash. They don't have to renovate it with their cash. They use the other people's money. Now they just have to pay those people interest to use their money, right? So that's what most investors do. What I did is I was like, you know what? How can I use less of my money, just use more borrowed money to do this deal? And I'm like, well, I've got the insurance policy. I could just borrow out the hard money lender and the private money lender's interest that I'm going to owe them, which over a 6-month time frame, I think it was about $30,000. So I'm using borrowed money from my policy to pay the hard money and private money lenders their $30,000 over 6 months. Mm-hmm. So what money do I have in the deal? The 30 grand is not mine. It's the insurance company's money. My 30,000 is compounding in my policy tax-free. Only thing I've got in that deal is the 5% interest I have to pay to borrow the insurance company's money. Mm-hmm. So if we look at my calculator, we got, let's say $30,000 times 5% is $1,500. And that would be $750. These numbers are off because I think I only had about $200 and something in the deal. But let's just say if those are the numbers, the only money I actually had in the deal is 6 months of interest on $30,000, which is $750. So that's it.
And what was the total? What was the total price of the deal?
Gosh, that one was
it's like 600, 700, something like that.
I think I bought it for $625. I can't remember the exact amount I put into it, but it turned out to be like cash on cash, like a 18,000% return.
Yeah.
So I turned, like if we do that, $750, if that's how much money I actually have in the deal, multiply that by 18,000%, and that was my return.
Yeah. And so so you renovated it with the private money, and then you refinanced it into one one loan, one, like, I guess a 30-year or 15-year normal loan, conventional loan, and then you list it on Airbnb for what?
I think we're like 300 and something bucks a night usually. What I do is a little different with the Burr method. So when I tell people this, they're like, that's so smart. The Burr method is it's a great way to build wealth, but there's kind of a hole in it. Like if you think about the refinance part of it, and I know this because I did mortgages for a very long time. Refinance is when you're doing cash out, which is what the Burr method would be, is a cash out refinance.
Yeah.
You have seasoning guidelines. So you have to have that loan for 6, 12 months just to be able to qualify for the cash out loan. So let's say you're done with the deal in 4 months.
Yeah.
It's fully renovated. You're ready to exit. But the lender says you got to wait 12 months for the seasoning. That means you're trapped in the hard money and private money payments, which are higher interest,
right,
for 8 more months.
Right.
So what I do is a little different. I don't refinance. When I'm ready for that step, I sell the property to my wife. So she's a W-2 employee.
That's right. I forgot about that. Yep.
Yeah, dude, she's super bankable. She got great credit. We don't have a lot of debt because everything we do, we use policies for.
Right.
So she's very bankable. So she's not part of the LLC that purchases the property. The LLC is just it's separate entity. So that entity can sell it to her with no conflict. So then what she does is she brings the down payment, which goes to the lender on a 30-year mortgage. All the proceeds come to the LLC. All I do is I just pay her back the down payment she just made.
Right.
Pay back the hard money, pay back the private money. And now we're into it for no money. We've got nothing stuck in the deal. And we can kind of dictate the end price, because if you're willing to pay me $6,000 for this phone, how much is the phone worth? $6,000.
$6,000,
right?
Yeah.
Yeah. Value is dictated by what someone's willing to pay. Like art is a perfect example of that, right? But if you look at a house, if I sell it to her for, let's say, 1.5 million, and every other house in the area is going for like 1.3, 1.4, but she's willing to pay 1.5, that's the value of the house. Right. So the appraisal generally comes in right around what we're buying it for. So we can kind of dictate where we need it to be in order to get all the money back out for her down payment, paying off private money, paying off hard money. So it's just a better way to do it.
That's genius, man. Absolutely genius.